Hello, and welcome to the Harvard Business School CEO Forum today. My name's Edward Hughes. I'm delighted to be here today. I want to thank you all for joining us. Let me give you a quick overview of the HBS Club and some of the things that we do, and then we'll get into our main event today. So firstly, I hope everybody is well and that everybody is safe. Clearly, these are challenging and unusual times, and not only in work, but personal lives, people have had to adapt, and the HBS Club has had to adapt as well. Normally, we do our CEO forums in person, but obviously with what's going on with the coronavirus, then everybody has switched to virtual programming, and which has been good. It allows us to basically get a different set of CEOs to come in and talk, and I'm delighted by the CEO we have with us today. So our mission as a club is to continue to educate leaders who make a difference in the world and make San Diego a great place to live and work. And we do that via a number of forums, whether it's the CEO forums today, whether it's our management development programs, whether it's our work with our social enterprise initiatives. So there's a lot of activity that the club does, and some of which you can capture in our newsletter, which we just put out about a month or so ago. That's on our website, and that'll talk about some of the activities and some of the roles that we do and the type of things that hopefully make us a valuable resource to our members and to the San Diego community. Let me just address a couple of upcoming events that we are very excited to have. We have on October 5th, Professor Frances Fry. She's a organizational leadership expert, and so a very popular professor, and certainly a well-regarded one, and so we're delighted to have her on a virtual event. HBS is doing its HBS Global Networking Night, which this year is going to come across in two forms. So on the first night, it's going to be an event put on by HBS, and the second night, local clubs are going to be doing a discussion around the topic that HBS is doing on October 20th. On October 22nd, I actually have a section mate of mine, Kevin Sneeder, who is now the global managing partner of McKinsey & Company. So he's just moved back from Hong Kong to New York, and we're going to be talking to him about a whole wide range of issues on the economy and politics and climate change and all kinds of important topics that certainly McKinsey plays a pretty big role in looking at. And then on November 5th, we have Robert Engel, who is a Nobel laureate of economics and a professor. And he is, it's going to be perfect timing right after the election. I'm not sure whether we'll know the election result or not, but if we do, he can certainly talk about what he thinks some of the impact of whichever party's got into power is going to have on our economy, and try to make sense of some of the things that have been going on over the last 12 months, because obviously we are living in some pretty unusual times. And then one final thing I just want to say before I introduce our guest, we are very proud at the HBS Club of San Diego of the work we do to really promote nonprofit organizations here in San Diego to make the fabric of our community stronger. And we've been doing this for a long time, for the last 15 years. And the red columns here indicate the investment we've made in education of CEOs of nonprofit organizations, where we've been sending them back to Boston for a week-long program called Strategic Perspectives in Nonprofit Management. And then the green is more recently the donations we've been making to help these local nonprofits, provide basically a better foundation for them. Obviously, they're playing a big role in some of the activities that are going on now. Today, the event will be basically a fireside chat event. And so I will be talking with Bill Ackman, and I have a number of questions for him. And then at the end, we'll be opening up to questions. Those questions will be done such that you can type them into your question tab. And basically, I'll try and get to as many questions as possible. This event will be recorded. It will be posted for the HBS Club of San Diego members and for other registrants that unfortunately, if they couldn't make it, even though they registered, they couldn't make the event, that basically they can watch it at a later date. So with that, let me introduce our guest. So Bill Ackman is the CEO and portfolio manager of Pershing Square Capital. It is a $11.5 billion fund. It's regarded as a research-intensive value investor, that takes primarily long positions in public markets. Prior to Pershing Capital, he was founder of Gotham Partners, involved in another organization before that. He has his MBA from Harvard Business School. He is, in fact, a section mate of our treasurer, Tim Ackman, who's on this our webinar. He went to Harvard undergrad as well. He's involved in obviously a number of companies. He's an advisory board member of the Federal Reserve Bank of New York, and involved in a number of different foundations, including his own. So Bill, welcome. Thank you for taking the time to join us.
Sure. Thanks for having me on.
Yeah, no, it's great. So let's start with, maybe you can just tell us a little bit about Pershing Square and the types of things you do and what you've been up to.
Sure. So Pershing Square is about a 17-year-old organization. What we do is we take very kind of large concentrated positions in public companies, large minority stakes, generally in businesses that we think of as great companies, but ones that have gone through sort of more challenging times. Therefore, their stock prices are more reasonable, and we can take a meaningful stake and then work with the companies to fix the problems. You know, the most relevant recent example perhaps is Chipotle, where a number of years ago they had if you remember, a food safety crisis, cost them a meaningful percentage of their sales, loss of, kind of damage to the brand. We bought a 10% stake in the company, recruited a new board, about 4 new directors out of 8, and then selected Brian Nickel as the CEO, who's been running it for the last few years, who's really done a fabulous job with the company. So that's sort of the prototypical what we'd like to achieve. We don't get them all right, but we've got a pretty good batting average, and that's kind of our core strategy.
So it sounds like you heavily involved in these companies. You're not just taking a passive position. You're getting involved in and really working with management or changing management to kind of drive a strategy that you like. Is that a fair assessment?
Yes, sure.
And how do you come up with a strategy? You just kind of look at the company and decide what you think it should do, or what's the process for that? It's bespoke, I would say. It depends on the business. We've invested in a pretty broad continuum of companies, everything from railroads and scientific equipment to consumer franchises, restaurant companies, small amount of retail, both good and bad. But it really depends on the situation. But I think our key job is making sure the right person is running the company. A lot of it is based on, I would say, CEO selection, and then proper governance oversight. But we look at a business and we look for opportunities for driving everything from improved customer experience to looking at the cost optimization of the business, or just even a general strategic overview of the company. So I would say everything I guess a consultant is supposed to do. We don't charge a consulting fee. We take a stake in the company, and we're one voice of a number of voices on a board of directors typically. And the key thing for us is we generally don't get involved in the day-to-day operations of a company. It's really about finding the right CEO, giving him or her the right incentives, and then just holding them accountable and paying attention. And how many companies would you have in your kind of portfolio now that you've invested in?
So we have 9 today, and we're looking for number 10, and that's fairly typical. It's maybe as many as 11 or 12 on the high side, and as few as 7 or 8 on the low side. But we take pretty large. Typical position size for us is 10 to 15% of the capital that we manage.
Okay, so it's pretty concentrated. So how long do you hold these positions for?
A long time. Our favorite, we'd like to find businesses we can own for many years. I would say in terms of the development of the firm, we weren't always set up in a position to own investments on a super long duration basis. But the most, over the last few years, we've positioned ourselves where today about 85% of our assets come from a public company that trades in Europe. It's called Pershing Square Holdings, and the employees of Pershing are the, if you will, controlling shareholders of that company. So we have the benefit of what some people might call permanent capital, but very, very long duration capital, and that allows us to be a long-term investor. But I would say, we own things for years. Our longest standing investment today is approaching a decade. so it tends to be long duration.
Okay, so long duration, obviously, and concentrated. Do you ever go above the 10 to 15%, like try to own the whole thing like a Warren Buffett, or are you're focused on that minority position, but enough to make a change?
Sure. So in terms of ownership, it's usually less than 10%. When I was referring 10 to 15%, I was referring to as a percentage of our capital base. We have one holding that we own approximately a 30% stake in the company, and the next largest is sub 10% range, or about 10%. But I would say mid to high single digits is typical. We're often the largest shareholder, or we're usually certainly the largest active shareholder. Sometimes we're smaller than the Vanguard, BlackRock kind of index fund owner. But these are generally pretty large companies, S&P 500, North American domiciled companies. So it really is our target.
Okay, and I read recently you've been raising some money, so I have an intent to do some SPACs. So maybe you can talk a little bit about what you're thinking there and what the game plan is. Sure.
So about 9 years ago, we invested in someone else's SPAC, but we were the anchor tenant in a SPAC called Justice Holdings, and actually we became if you will, a co-sponsor by becoming an anchor tenant shareholder and by taking about a third of what we'll call the founder economics and giving those economics to our investors. It was our first experience with a SPAC. We actually identified and sourced, negotiated, and closed a transaction to merge that company with Burger King. 8 years later, or 8.5 years later, we're still the second largest shareholder of the company to the controlling shareholder, 3G. It's been a very attractive investment, and we've been, I would say, an important shareholder in everything from bringing them ideas, the idea to acquire Tim Hortons, the Canadian kind of coffee donut chain. We've been involved in most of the major decisions that the company has made over time, and kind of good experience, and that really opened our eyes to what a SPAC is, what's good about it, what's bad about it. And we vowed sort of internally, we said, look, when conditions make sense, we should do another one of these on our own, and we should fix some of the problems of so-called SPACs. And a SPAC, for those of you who don't know, is getting a lot of press more recently. It's basically a cash shell where a company does an IPO, raises a pile of cash, looks for a company to merge with, a private company that they can then take public in a merger. And the basic concept is sound because it allows you to, in effect, do an overnight, not quite overnight, but a faster tracked process to going public without the kind of distraction of the typical filing of prospectus, a 6-7 month process until the last day you find out whether it's done or not. That's the traditional IPO process. With us, we can give a company certainty just by the time we negotiate a deal. But what we did is we took the conventional SPAC structure, which has as I described it, an egregious compensation structure, so it attracts a lot of people, and we eliminated this, all forms of compensation to better align our interests with investors. And we had a very enthusiastic, response from investors. We had over $12 billion in demand for a $4 billion IPO. We picked what we think of as sort of the best long-term investors. And what we're spending most of our time on, substantially all of our time today, is looking for. And I guess I reach out to the HBS Club of San Diego. Does anyone own a super high quality, long duration growth company that they'd like to take public in an overnight, not quite overnight, but where we can give them certainty in as much time as it takes us to do due diligence, inject $5 billion of equity into their company, and position the company for growth, or give them the ability to take some capital off the table. But we're looking for pretty big companies, typically $10 billion plus market cap companies. And
these are going to be part of the 10 companies you typically have in your portfolio, or you manage? Yes. This is a separate group.
Yes. No, this is how we're going to deploy. We didn't do this to raise money for ourselves. We're not increasing our management fees or incentive fees by doing this. We did this to enable us to acquire a large stake in a company just before, sort of the instant it becomes public. That will be idea number 10 in our portfolio, and we've set aside, as much as a couple $2 billion for that idea.
And I think your methodology is going to be a much less expensive to do than the traditional IPO, or even compared to other SPACs, because other SPACs usually take quite a big portion, right, or quite a good fee out of the company.
Yeah, we took nothing. So we didn't take any fees. We didn't take, the typical SPAC structure, you raise a $400 million SPAC and you get a deal done and you get 100 million of common stock for the so-called sponsor or founder. That's a nice gig, but it's not the ideal. It doesn't create a lot of alignment with investors. It really motivates people to do deals as opposed to good deals. Obviously they prefer a good deal versus a bad deal, but that amount of dilutive compensation makes it hard to do a deal that makes sense. What we did is we said, look, we don't want to be paid to do this. So we're going to put up $1 billion of our own capital. We're going to raise $4 billion from other investors who we're going to partner with. And the only economic difference between what we get and what the public gets is we got an incremental opportunity to purchase a warrant on the new target company, basically a warrant, a long dated option that struck 20% out of the money. We can't sell that option or that warrant for several years. And we hired Houlihan Lokey to value it, and we purchased the warrant contemporaneous with the IPO. If we find a great company, we get a deal done, that warrant could become very valuable over the next 10 years. If we don't find a good deal, we'll lose our investment in the warrant. So it's a way to give us a little bit more levered upside combined with our $1 billion plus investment in the company. So it's what we think we did is fixed some of the problems of the traditional SPAC structure, and investors seem to agree. And now we just need to find a good company. Yeah. And other than this Zoom call, that was what I was working on.
Okay, all right, okay, good. So now, obviously, as we've talked about, you're mainly taking long-term equity positions. You're not really known as a trader, but yet in March, you made what maybe one of the greatest trades of all time when you bought some insurance for, I believe, like $27 million, betting to protect your portfolio, and it turned into 2.6 billion. So that's awesome. Tell us about that.
Yes, so that was a good experience. Our day job, as I mentioned, is to find 10 great companies that we can own for many, many years. But part of our day job is protecting our investors from losses. And I'm a big fan of asymmetric risk-reward ratios. And I'm also in favor of protecting our portfolio from losses. And really what happened was, beginning in January, I became kind of, if you will, gravely concerned about the virus, first from a health perspective. And then when I saw how it was addressed in Wuhan, I then became very concerned about what it would mean for the global economy. And my conclusion was, one, the virus would spread everywhere because it was spreading asymptomatically. And two, that the only way to stop it was effectively to shut down the global economy. And the capital markets had never seen a coordinated global shutdown. And so, owning businesses, we own 3 restaurant companies, restaurant brands, Chipotle, Starbucks. We own Hilton. We own businesses that we thought could be dramatically affected. And our choice was sell everything and short the market, or put on a very, very large hedge. And we decided to go the latter route. And the instrument we use to hedge is basically a credit default swap, but what some people might call an insurance policy against a company, or in this case, we used index credit default swaps, a portfolio of companies defaulting, a portfolio of investment grade, in some cases, and high yield, in other cases, European investment grade companies. And that insurance, at the time we purchased it in February, was very, very cheap, because people did not, the credit spreads had come in, over the last several years to pretty close to the all-time tightest levels. And people didn't see a scenario, the economy was very strong, that would cause credit spreads to widen, and we did. And so therefore we were able to buy very, very large amounts of insurance, basically what amounts to a $71 billion insurance policy at a relatively modest cost. And then over the next 3 weeks, not even 3 weeks, the cost of that insurance went up a lot. And that the inherent leverage of the instrument, really one-way leverage of the instrument, caused our investment to become very, very valuable. And then we did well putting it on. We arguably did better taking it off. So we took it off pretty much at the highs. And then at that time, the stock market, was very cheap. The companies we knew best were our existing holdings. And we just spent that money, or 80+% of that capital, buying more of the things that we owned. And our basic view is that the markets would recover as long as we took steps to prevent the spread. And that's basically what's happened.
All right. So you bought it in February. The value of the swaps went up, obviously, as the market tanked, and then 3 weeks later, you basically cashed in the policy essentially, and then turned around and reinvested back in the market. I mean, that's
Yeah. So again, we don't normally think of ourselves as good traders. On this one, we got a gold star because we bought at the low, sold the insurance at the high, and we kind of bought at the low. So far so good.
yeah. Who was on the other side of the swap?
We don't really know, but likely, what we've been told is it's likely the really big fixed income players, the BlackRocks, the Bridgewaters, the big institutions. And the good news is it's not like there was one big party who, collected $27 million in premium and paid out a $2.6 billion claim. It was probably spread very widely in the market and institutions that have huge balance sheets. So it was a hedge which really benefited our investors. And I don't think it cost anyone. You don't read any stories about rogue traders being fired. So I think no one got hurt too badly because it was so widely disseminated, the other side of the insurance.
So no one was calling up all pissed off about it that you
not
cash
so
in
far,
billions of dollars from them.
So far, so good. Yeah, so far, so good.
So obviously, as you say, most of your investing is long-term style, and you've been called obviously an activist investor. How do you feel about that title? Is that a fair reflection?
Let's put it this way: there's a continuum of investing. There's passive indexing on one side, and there are people who make tender offers and buy control of companies. I would say that's the most extreme side, and we're somewhere along that path. But we're definitely an active, engaged investor. We hopefully can be helpful to the companies we take stakes in, and we are. I guess it's a proud badge of honor being a so-called activist. My mother was a community activist, so perhaps I inherited some of those traits from Mal.
Okay, all right. Now you kind of touched on some of the companies in your portfolio. They sound a pretty diverse group. I mean, they sound like large North American companies predominantly, but I mean, there's a lot of different sectors. How do you go about figuring out what you like, what sectors or which companies you like?
Yeah, sure. So we focus on what I call simple, predictable, free cash flow generative businesses. And so it's got to be simple enough that we can understand the company. And if you think back to HBS, we read a lot of cases about different businesses, and there's some businesses, I know I have no clue, and others I can predict with a pretty high degree of confidence what they're going to look like over time. And so it's really the latter that we focus on. It has to be a business. So we've really done very little in things like biotechnology, commodity sensitive businesses where you have to be, kind of clairvoyant about the direction of commodity prices. Our businesses look like growth annuities. Very simple. Starbucks, right? They've got a certain number of stores. They sell a certain amount of coffee every day. You can sort of model up what that company's going to look like over a very long period of time. And our job is a bit of the Michael Porter 5 forces analysis, right? What are the factors that determine the company's competitive position? How sustainable is it? And that's really our job. And then we have to make sure we pay a good price.
Okay. So you largely stay away from technology companies?
I would say today every business is, Starbucks is a technology company. One of the reasons why Starbucks is succeeding today is they've got a great digital offering for their customer. They've got a great digital interface, in the way so I would say technology plays an important role in every company that we invest in. We've not invested in what I would describe as a pure technology company. Think a self-driving company or an electric truck company with no revenues. We look for businesses that are well into the proven stage. They've got real revenues and cash flows.
And I mean, a lot of the businesses, the restaurants, the hotels you talked about, you've invested. I mean, this has been a rough year for those guys.
Yes and no. Actually, Chipotle continues to do extremely well. All of them experienced a big downturn in the business, called end of Q1 and Q2. But this is a very good environment. Starbucks will be a better, more profitable company post-COVID than if there were no COVID. And Chipotle the same. I mean, Chipotle has a very successful. First of all, burritos travel very well. Versus ordering a hamburger and fries.
Yep.
Fries don't do that well, 40 minutes later. burritos can actually taste better. You know, the cheese melts a bit, it's still warm, comes in that little silver foil, and it's you know, so Chipotle's digital offering went to become, you know, something like 70% of sales, and even today it's 40 to 50% with the stores reopening. So it really accelerated. You know, it sort of put Chipotle in a similar place to a Domino's Pizza, which was, you know, a pure delivery company. Now Chipotle is becoming a much more delivery focused business, and they've got a very good you know, system. You know, the crisis has benefited kind of the strong, dominant technology forward companies, and that includes restaurant companies. It includes
hotel companies.
So Hilton is really what we call a brand royalty company. Hilton today owns very few hotels. You know, the hotels are owned, many of them by entrepreneurs and, you know, kind of large, you know, investors. You know, the hotel business itself is super capital intensive, very sensitive to occupancy. Hilton's core business is really selling the flag, you know, the Hilton brand plus a portfolio of a dozen other brands, and they get a, you know, percentage of revenues in exchange for the brand, and they help, you know, with things like marketing and reservations. And that business is a very, very durable business. All of that said, you know, this is probably the toughest period for the hotel industry ever. But, you know, the company is still, you know, we own it on the basis of the next 50 years. And again, we think the crisis will cause more independent hoteliers to hire brand. Now, my wife just walked in. She doesn't realize I'm on with 100 people from the HBS Club.
Sorry, love you. I have no screen. Love you.
Okay, I'm excited to hear.
Love you.
So that's Mary Ackman. By the way, you should be interviewing her. She's way more interesting. I was very fortunate. I wrote in my HBS. Tim would have this somewhere. The little book where you write about your around the reunion.
Oh yeah.
Like going through sort of tough moments, and one of those tough moments is went through a fair bit of challenge, you know, marriage, divorce, etc. But got very lucky in meeting an amazing woman, and we met 3 years ago and married. We have a baby, and I attribute all of my business turnaround to having the right partner in life. So I really encourage everyone to. Those two things are correlated, to make sure you're in a good marriage. Very important. Or it doesn't have to be a marriage. That would, you know, be a good relationship.
Well, that's good. Let's talk a little about some of the. You've had some, obviously you're having a great year. You've had some amazing successes. You've also had a few investments that didn't go quite the way you wanted.
Sure.
You call them reversals. So tell us about what happened there, and, you know, what do you learn from that?
Sure. So. I'm a big believer experience is learning from mistakes. You know, the investment business gives you many opportunities to make mistakes. Because we're so concentrated, you know, the mistakes are extremely visible because we're concentrated public, you know, so, you know, you know, our two biggest mistakes were one a long and one a short. We short very few stocks. I couldn't resist when I came across a company called Herbalife, which is actually based not too far from you in LA. The reality is it's actually a pyramid scheme. It's a public company. It's the best managed pyramid scheme in the world. And I figured we could put it out of business with a fair bit of research and transparency. And they did a remarkable job managing their PR and their regulatory risks. And they won in terms of, it turned, you know, they were able to settle with the Federal Trade Commission for a couple $100 million. They settled recently with the feds for foreign, you know, bribing people in China. They settled with the SEC for having misleading financial disclosure. All these things were things we pointed out to the government, but they did it in such a way that they managed to stay in business. But it was that one I call being right, but being wrong. So that's an interesting one. But we lost probably something in the order of $1 billion. But the really big mistake we made really relates to, we have a series of core principles, about 8 of them, that we apply to every investment. And both Herbalife and a company called Valiant Pharmaceuticals don't fit squarely in those principles. So I would say our mistake was veering from the core principles that have led to our success. And Valiant was regulatory sensitive, had a lot of financial leverage, needed access to capital in order to grow, clearly in retrospect had some management issues, and we were a passive investor, which we'd almost never do. So, I would say a long story, an investment that was made at a time where I was struggling personally. And another piece of advice here is it's hard to have good judgment if you're distracted at home. And so, I would say the learnings here were: one, stick to the core principles; two, make sure that you're happy in your personal life. And there are all kinds of temptations in the investment business, something that looks interesting. But what we learned from Warren Buffett is staying focused on a clear set of principles is a really, really important thing. And after the Valiant and Herbalife losses, which were, material and embarrassing, and there's nothing, it's never fun to lose your own money, but it's way worse to lose other people's money. And I really had not done that to any significant amount until the period of 2015, 2016. And fortunately, I called him. We had a real moment of reflection. It was a lot more than a moment, and I realized the mistakes we had made were, as I say, veering from the principles. So what I did is I took those core principles that I always talked about with the investment team. I had a member of the team literally had them engraved into these stone tablets that sit on everyone's desk, like kind of the 10 commandments, okay, or 8 commandments. And ever since we did that, we've gone back to the results that we got used to. So we had great 12 years. We proceeded to lose about almost a third of our capital on a couple of bad investments, and then we've had a very, very nice recovery. The last 2.5 years, we've up 2.5 times, which makes up for lost time. So, yeah, so as I like to say, experiences, making mistakes, learning from them, and success, a lot of it has to do with persistence and just not giving up and staying focused and every day making a little bit of progress. And that's what we did. And I've decided, however, that I'm done making mistakes now that I'm 54. That's it. No more.
As long as you look at that stone tablet, you should be.
That's all I need to do.
Okay, that keeps you grounded. Great. You've also changed your portfolio a little bit. I mean, I looked, and you used to have a lot of stuff in retail. Tell us how you think about retail now with Amazon. Just certainly the pandemic has accelerated e-commerce, etc. I mean, is retail a space? I mean, probably stuff is dirt cheap, but is it a persistent good cash flow model going forward?
The answer is it depends. So in a way, we have 4 of our 9 portfolio companies are really retail companies. 3 in food retailing, right? 3 kind of quick service restaurants or coffee chains. And then we have Lowe's, the home improvement company. And I don't like retail as a business, the business of selling things where you have to constantly rely on customers coming in every day and buying, particularly in a world, I understood what Amazon was doing. My biggest investment mistake was actually not Valiant or Herbalife. It was not buying Amazon a decade ago, or, I had every opportunity, but I just never took the time to read the annual report, sort of my bad. Look, I think, what's happened is the world has changed very dramatically, and the retailers have not changed with the changes in the world. And what will happen is, I would say today is probably one of the better times to both open a restaurant and open a retailer, but you have to, have a model that's appealing to today's consumer. And, I think that's, the problem with the mall business is the tenant base is going to change fairly dramatically from the Sears, JCPenney, Macy's, Bloomingdale's, the sort of big anchors, to a very different, much more entertainment. I think that, particularly after pandemic, everyone's going to want to go have some fun. Right. Some mix of shopping, entertainment, retail format will do very, very well. But I think there'll be much more, I would call it modernized concepts from what we've seen. The problem with a lot of businesses is they develop a certain approach and success, and they don't adapt. And that's why, you've seen the big department stores struggle.
And yeah, I mean, obviously there's a ton of retailers that are struggling and going out of business. And were there any times maybe early on in Pershing that you were kind of wondering, were you guys going to make it?
Oh, as for us as a business, sure. I would say very few investment firms have survived a period of negative performance as long as the period we had. We had really 2 bad years, and then 2 pretty close to break-even years. but that's no great shakes. We had the benefit of 12 years of superb, 12 years of 21% compounded performance. And then we gave about 30% of that back. And the reason why we survived is we changed our capital structure. So one of the things I learned from Warren Buffett is he started out as a hedge fund manager, actually an activist hedge fund manager. He doesn't talk about the activist hedge fund manager days, but he managed a series of partnerships, charged a 25% promote, and that's how Buffett got initially rich. And 15 years in, he went to his investors in 1969 and said, look, I'm kind of tired of running this hedge fund thing. I'm going to, he had a large holding in a company called Berkshire Hathaway, which he called a crappy textile company. And he said, look, I'm kind of more interested in running that than running this. If you want your money back, you can have it. I'm not going to work as hard going forward. I've made a lot of money. And a lot of people took their money. And he took stock and ended up as a controlling shareholder of Berkshire Hathaway, which has been his principal investment vehicle. And the beauty of Berkshire is because it's a company that trades on the market, the capital base is permanent. And having permanent capital in a world where the vast majority of other investors, whether they're mutual funds or managed accounts or even hedge funds, have impermanent capital is a huge advantage. So I certainly watched that approach of Mr. Buffett, and about a little more than a decade into Pershing, I raised a public vehicle not dissimilar to Berkshire in terms of concept, and that entity is called Pershing Square Holdings. I mentioned it before, and when, if you will, the shit hit the fan, we went through this difficult period. We had a large amount of investor redemptions from our private funds. The public company went to trade at a discount to its net asset value. And I did something I really hadn't done at that point in time. I borrowed a bunch of money and with some other resources bought a controlling stake in our public company. And that put us as a firm in a very similar position to where Buffett was in 1969, in control of a public company where the bulk of our assets would reside. And I got out of the business of raising money and meeting with investors. And the problem, when I look back at the problems we had at Pershing, a big part of it is I got stepped away more than I would have liked from the investment process just to become what amounts to the chief marketing officer for a hedge fund, something I never really wanted to do. And I decided I wanted to go back and just be a pure investor. And, so we've had a lot of redemptions out of the hedge funds, but we've compounded the capital of this public company at a pretty high rate. It's now, call it 10 billion of assets, and the money is permanent. And so we don't have to worry about short-term capital flows. And that has contributed to, I think, our period of successful performance. But in the dark days of, call it late 2017, we were still down 30%. I hadn't yet resolved my divorce. We had litigation in connection with the merger. And Brad Pitt was trying to steal my girlfriend. True story. Okay. But, it was a pretty grim, sort of moment in time. And I thought about what some people in my industry do, open the proverbial family office. And I really didn't want to, I'm not a person who gives up. And I felt that the investors, certainly once stuck with me, I didn't want to have anyone who ever lost money investing with me. And so that kept me focused. And then we started making some progress. And, I'm pleased to be back to, kind of the generating the returns that we used to earn. And if you bet with us in the deep dark days, you've done incredibly well. We've the last, as I mentioned, we're 2.5-fold since March of 18. Brad was unsuccessful in stealing my girlfriend. I resolved my divorce. We resolved the litigation. Happily married. We have a baby, now 16 months old. Have 4 girls. How can life be bad? So, and again, you should interview this Neri woman. She's pretty remarkable. And if you're interested in learning about Neri, she has a really cool TED Talk. She did it's a little bit old now, but you get a sense of some of the work that she does. So I encourage you to check it out.
Okay, I'll take a look. So the Brad Pitt story sounds interesting. So,
by the way, I don't mean to say that Brad did anything wrong, but yes, he has good taste. That's all I can say.
All right. Okay. You talked a bit about Warren Buffett in his early days. So obviously you're an HBS guy. So why'd you pick HBS? You probably could have gone to any business school.
I went to HBS because I thought, without doing any due diligence, that it was the best business school. And I went to business school because I wanted to learn how to be an investor. And I learned one of the first lessons of investing after I arrived on campus and went and picked up a copy of the course catalog. And I went looking for the courses on investing. And if you remember back in '92, there was no course on investing. Unlike Columbia, which has like a whole value investing program, part of the ethos of Columbia, HBS had a class run by Jay Light on basically how do you run an investment, how do you become the next CEO of Fidelity Investments, right? Which wasn't particularly, again, I'm not interested. I don't view what I do as asset management. I view what we do as investing and managing a public company, and that's really what I want to do. So lesson one of investing is do your due diligence before you wire in the tuition. So, but I had an amazing experience, and I created my own self-study program, and that led me to open actually a Fidelity brokerage account with tiny little bit of money I had from my job between college and business school, and I started investing. And the first stock I bought went up, and I'm like, okay, this is cool, and that led to my focusing on this industry.
What led you to wanting to be an investment manager or investment guy?
It's a bit like you read Jean-Paul Sartre's essays on existentialism, and you say, wow, this fits with my view of the universe. I read the kind of the classic way people end up in becoming, so to speak, value investors is they read Ben Graham, they read Warren Buffett, and it spoke to me, and I was intrigued by it. I also met Seth Klarman my second month at business school. He came out with a book called Margin of Safety. Seth manages around $30 billion, very successful investor. And I called him up and went to see him just for advice. And what I liked about this business is it was very accessible. You could practice being an investor with a tiny amount of capital and learn valuable lessons. And I just really liked it. And so being interested in investing, I think you're a better student at HBS when you have sort of an end goal in mind. And so I guess I paid more attention in accounting and finance, and competitive strategy with Michael Porter was one of the most important classes I took. Mm-hmm. Michael's actually has been on our advisory board for 16 years.
Oh, cool. And you started your own business pretty much straight away out of HBS?
Yes, we launched September of '92. We formed an entity, started raising money. We put $3 million together. We started investing capital in March of '93, believe it or not.
Now, some people like, Bill Sommel say, go and work for someone, learn the ropes, etc. Learn on their dime. You can make mistakes on their dime. You went out and did your own thing straight away.
Yeah.
Why'd you do that versus joining an investment firm and getting some experience with those guys?
Because I didn't want to work for anyone else. So that's probably the main reason. And I thought rather ignorantly that I knew enough to manage other people's money. I figured the worst case scenario was if we were unsuccessful, I'd get a job.
Okay.
So, and I was unmarried, didn't have a high burn rate, and I could afford to take risk at that time in my life.
And how did it go in the early years in the investing? Because obviously it's worked out great now, but I mean,
Yeah, we had a fabulous first 5 years, went through a challenging period. We were in business for 9 years. At the very end, we had a few challenges, and ultimately it made sense for us to wind up. But my new favorite saying is bad is good. Good things come out of difficult circumstances, and that allowed me to restart, having learned from the first experience. I was partners with David Berkowitz, a section mate, Tim knows well. We're still quite close, but I felt better doing this on my own, and having learned from my previous experiences. And many of my investors from the first fund, almost all, became investors in the second one.
And you mentioned Warren Buffett a couple of times as kind of you learned from him. Are there other investors out there that you kind of looked at and said, that's a role model for me. That's kind of what I want to follow?
Sure. It wasn't so much one role model, although if there had to be one person, I would say probably Buffett. But I learned something from many different people. I learned some things from Seth Klarman, Joe Steinberg of Leucadia National, less well-known, very private person I learned a ton from. He was sort of an early backer, supporter of mine, but there are a lot of very talented people in this industry that I've learned from.
Yeah, I mean, there's a lot of different personalities. A study made of mine is Chris Holm, now Sir Christopher Holm of TCI. And
yes, Chris is
never guessed.
Chris is a great investor. I'm friendly with Chris. He's done a fabulous job, and he's also had some ups and downs. I mean, I think it's the nature of not just investing, but business and life.
Yeah, no,
but he's I would say he's certainly on a high now, and as I said, no more mistakes from me. I'm done with mistakes. That's all. That's pre 50 years old. After 50, no more mistakes.
There you go. You've learned the strikes. You've done with the mistakes.
That's the plan.
So, let me switch and ask you a little bit about some macroeconomic issues. We'll tackle some questions from you.
Sure.
You're an advisor to the Fed, so there's been a pretty big change in monetary policy over the last year with all the stimulus and the loans. What do you think about that? I mean, are we heading into a major crisis with the amount of debt we're issuing, or you think this is a good sustainable position? What's your take?
I think my take is I don't think we had a choice as a country, or as the world didn't have much choice. You have to support the economy during this kind of period. Taking a U.S.-centric approach, I think we have an enormously valuable. The asset side of the U.S. government balance sheet is very, very large. The liability side is obviously grown. I don't think we're approaching insolvency, but once we get through this period, this kind of where the Congress keeps spending $4 trillion a quarter, that's obviously not sustainable, and it's something to be sort of cognizant of. But it's very difficult to know what the long-term implications are. I'm certainly not happy with our current political situation. And I view the United States as the greatest activist investment opportunity of all time. It reminds me of some of the companies in our portfolio. We just need some better, more consistent leadership, and a lot of good things will happen.
I mean, we've obviously got an election coming up shortly, so whether it's Democrat or Republican, what would you like to see come out of this? What kind of policy would you like to see the U.S. be implementing to move the organization or the country forward?
Yeah, look, I'm generally of the view that neither, having this extremely divisive, with the nature of the system. Actually, Michael Porter wrote a very interesting piece that I don't know if you've read on his sort of competitive analysis of the U.S. political system. I think it's a must read. His basic argument is that the nature of a primary system with low voter turnouts causes, leads to, growing disparity, where people have to lean further right than they actually are, or further left than they actually are, or the most right and most left candidates are the only people that make it through the funnel, and it leads to the kind of deadlocked, situation we have now. I do think, my general view, it's sort of like a company that's not being well run. The first thing you do is you replace the CEO, and I wish we could attract better candidates for office. I mean, whether you're going to vote for Donald Trump or Joe Biden, I think you have to realize that they're both, not ideal leaders for various reasons. And we think in a country of 350 million people with a lot of super talented people, we could attract better candidates to better choices, and that's what I would certainly like to see. And I think one mistake the business community has made is kind of saying, well, it doesn't really matter who's running the country. I'm just going to focus on running my business. And I think that's led to where we are now. Mm-hmm. And, I always, for a while, I wanted a pro-business CEO, as our president. And, as I said before, I would say Donald Trump is pro-business and he's a CEO, but I think he's not the ideal leader, far from that. And, I think Joe Biden is, more the conventional long-term politician, and he has his issues as well. And I just know much more talented, capable people who I'd like to see running this country. So that's what I'd like to see.
It's a hard thing to throw your hat into that ring, because it's a brutal ring. Let me ask you one final question before I open up for these questions from the audience. So COVID-19, how's that going to change your investment strategy going forward? Does it change any of the 8 principles? Does it accelerate your interest in sectors?
It reinforces the principles, meaning what do we look for? We look for very, sort of the super durable growth company with a great balance sheet, excellent management, good governance. And that's what you want to own in an uncertain world, whether it's pandemics or climate change, or you just want the business that survives regardless of what's thrown at it. And that's really our target.
Okay, great. All right, let me tackle some of these questions we got here. So, question, what do you think of stakeholder capitalism versus shareholder capitalism?
Sure. So, look, I think every business, I think stakeholder capital, here's what I would say. Any company that is run purely on on driving a return for shareholders is probably not going to drive a very good return for shareholders. You look at a couple of simple examples. Chipotle focuses on sustainably sourced, high quality, ethically raised, protein, cattle, etc. And that leads to better tasting food, and that leads to happier customers, and they pay their employees well. When you take care of each of your various constituencies, and you're better for the world, better for the environment, I think you have a higher probability of success, and ultimately you're going to build a more profitable business. So I think the basic idea of stakeholder capitalism is a good one. Now, what I'm saying though is what's in the long-term best interest of shareholders is running your business where you're taking care of all of your constituencies, the communities in which you operate. You got a team that feels like you're looking after them, and you're compensating them appropriately, and you're thinking about your customers' needs. Look at Jeff Bezos in terms of this purely customer-centric philosophy where he didn't focus on generating profits, for a very, very long period of time. And he built the world's most valuable company. Now people can you see various articles critical of how hard the employees work in the warehouses, but again, any big company can be criticized. You're not going to keep your workforce motivated if you don't treat them well, and I'm sure Amazon is very focused on having happy employees and running the business. So I think the idea of stakeholder capitalism is a very good one, and it will lead. I don't think it's orthogonal, if you will, to benefiting the owners of the business.
Okay, great. Another question relates to the SPACs, and so how do you think about Pershing's value add in the SPAC in itself? Besides the surety of your ability to close and the tightened time frame to close, are there other elements of a SPAC that makes it more attractive to a large company than an IPO?
Sure. So I would say, number one, we are going to be a very large investor in the company, and we can help a company transition from being private to being a public company. We're a well-known investor in the capital markets. If you've even inclusive of our mistakes, our average return on invested capital has been in the mid-20s. That's a pre-fee number, and the public doesn't pay fees, obviously. So if you bought the stocks that Pershing owns, in total, you've been a very, very happy shareholder. So one, the person setting the value for the company has a very good track record as a public shareholder, and people like to invest alongside us. We can give someone certainty without any public, until there's a public announcement doesn't come until the deal is certain. So a month or so to a certain public announcement. We're writing a $5 billion equity check, so we're injecting $5 billion of capital into the company. That makes this in the top 4 IPOs of the last decade, and degree of difficulty for an IPO goes up significantly. We're going to be in this for the long term. But one of the other things we did that's interesting is we had a large amount of demand for the IPO, which enabled us to select the investors that own the stock in the SPAC. And it's a group of investors that in general have never before invested in a SPAC. And it's a group of, I would say, the most highly regarded Asian pension plans, Canadian pension plans, state funds, billionaire family offices. It's a network of investors globally that could be of assistance to a company that's sort of going public. And so what we're offering is certainty, scale, a great starting base of investors, and you get a kind of anchor tenant investor who's going to be a long-term shareholder of your company. And then the way you go public, typical CEO, you start a process, it's a 6 or 7 month process, and the CEO runs around telling everyone the same story and trying to convince them to give the company money. In our case, we announce a merger. We explain to the public why we chose this business, why it's a great company, why we like the management, why the terms make sense. And then we open it up to management to tell a little bit about their story. But it's a much more efficient process. For a company focused on growing their business, they don't have the same distractions as a traditional IPO process. So I think it's simplicity, certainty, the backing of a large shareholder, and a very unusual base of long-term value-added investors, which you don't have the ability to create if you go public in the conventional fashion.
All right, so that's kind of talks about the value added. There's another question. Can you give us a little more color on the types of characteristics you're looking to partner with in a SPAC?
So just, I mentioned the 8 principles, the same principles apply here. We're looking for a super durable, high quality growth company, a business, that would pass Michael Porter's 5 forces test, a company that we can predict with a pretty high degree of confidence its sort of dominance over a very long period of time. And it's run by, a very talented management team with, the highest integrity.
Okay. What are you excited about going forward?
I'm excited about Neri Ackman. I've mentioned her a few times. I'm excited about my 4th child and watching my 3 older ones grow up. I feel very good about where our business is. I feel like once you cross the Rubicon, I'm 54 now. I made a decision a few years ago after going through this very difficult period. I was going to set my life up in such a way that I would be happy every day. And I only spend time doing the things I love. I spend as little time as possible doing things I don't love. And I think that's a very good way to live if you can organize your life in such a way. And I feel like Pershing, the business, is organized in a way that is ideal from a quality of life perspective. It's also ideal from an investment perspective. So that's a win. And personally, I'm in a very good place. So I'm excited to live my life and play out the next 20 years. And it's a very cool thing. My last child from my first marriage, was born 14 years ago, and it's kind of a complete, restart to start that all over again. And I highly recommend it to anyone who's thinking about it.
So maybe you can elaborate. What did you stop doing, and what do you spend more time doing now?
So I spent too much time on an airplane meeting with investors raising capital. When you run a large hedge fund, at the time we had 18 billion, I think we peaked at 20 billion, but it was impermanent capital, and 10–15% of that money left every year, regardless as to how well we did as a business. And just to replace that capital, to keep a stable capital base, if you've got a couple hundred investors around the world have given you, $100 million each, they each want to see you only for an hour, and that's your year, right? So they typically want to see the CEO. So it's a very, you have to transition to becoming a marketing person, and I didn't want to do that. So I gave up, the business of raising capital. We structured ourselves in a way where we didn't have to worry about raising money, and I could focus just on investing, which is something I enjoy. And that also freed up more time personally for me to live, a happy life.
And you're active. I know you're a big tennis player and that kind of stuff. So you're obviously keeping yourself active and healthy and doing that.
Yeah, I'm super into tennis, health, nutrition, longevity. If you're happy, you want to live as long as possible. And, when you have a little infant, you feel an obligation to live as long as possible, let alone the smile that can give you. So yes, I'm focused on living a long time.
Well, that's great. Well, with that note, I want to thank you very much for taking the time to spend the hour with us. This has been great. We really appreciate that. And I know Tim was super excited to reconnect and kind of get you onto this program. So Bill,
thank you, Tim. Thanks for inviting me. And thank you, Edward. Really enjoyed the interview. Appreciate it.
Okay, thanks. Thanks.